Hi, everybody. Eddie here. It's been a couple of weeks since my last update. I had some personal issues I had to take care of, so I didn't have the time to do any market updates over the weekend. So thought I'd do one today. So before we start, please like and subscribe to the channel for future updates. It helps with the algorithms and it'll encourage me to do more of these videos. All right, so last week we had a really nasty week, right? So everything was looking well, and then we got rejected off a major resistance area, and then we came all the way back to the lows of the February lows just before the Fed meeting, right? So here's a look of IWM. So IWM is the small caps, and you can see we were in the range there for about a year, and then we finally broke down, right? You can see that this is the weekly chart. So you can see that we broke down the consolidation. We came back, we retest the 21, and then we came back and broke. So it actually broke through the lows of February the 24th, February 22nd there. So that low was a really important low for support, because if we break through that, there's not a lot of room on the downside for support. So the next level is right here on the weekly 200-day moving average, and there's a big gap around here, pre-COVID gap, right? So this is the gap that launched this rally in 2020, and most likely we're gonna come back and fill that gap. Right, so this is quite a bit down. So if you measure that, that's about another 11% downside for the IWM, and it doesn't mean it's going to stop there either. So there's some major support right around this area. So if you look through here on the volume shelf, a majority of the people bought into this rally around this consolidation area right here, around the 200-day moving average before the launch. So this is most likely going to be our bottom. So if you are looking to invest in small caps, then you're looking at IWM to fall around this area right here before it bounces back. So there is another leg down. So and that would fall into this downtrend as well. So just be very careful. You're still holding small caps. I took my losses on the small caps already. I'm barely holding anything at the moment. So like when markets turn, you really have to take the initiative and take your stops, right? It doesn't matter how you like this stock, right? And even though they have bright futures or whatever, in market downturns, in these type of environments, you really got to cut your losses and cut them as early as you can. Once you see weakness, you don't want to hold them anymore, especially with the indexes. All right. Okay, so move on to QQQ. So QQQ, as you can see, I talked about this last time I updated that this was a major resistance area. So we rallied up and hit right into that resistance, that 200-day moving average, and got rejected hard, right? We actually tested one more time before the fall down. So as you can see right here, we actually came back, test the 8, rally back up, retest the 200, failed the next day. And once we failed that, it's coming straight down, right? So that's exactly what happened right here. It came down, it broke through the 50-day again, retest, failed again, and came back down. And on Friday, we actually closed below the lows. All right, so that's a really bad sign. So if there's momentum next week, we're going to have some sharp sell-offs, because there's some room to come down to. 300 area right here on the Qs is a psychological area. Also some support of this bottom, this volume shelf right here as well. So this is a really, really important area to hold. If we break through this, it's a long way down. We're looking at about 260 right here, and then it is the pre-COVID lows, which is it will be this 2.618 area to come down to. So if that breaks, you want to hedge, you want to short, you want to do whatever, go cash. Right now I'm mostly cash. Whatever long-term stuff I had, it was hedged. I actually took my hedges off, closed off the position with no losses, because I hedged them early when the 50 break, because for my long-term is mostly just index, so they were fairly easy to hedge. In right now, I'm sitting on cash. I'm looking for it to come down for opportunities for the next big leg up, right? So these are rare opportunities on sell-offs because they come like once in a few years for corrections and once in a decade for recessions. So if this turns out to be a big bear market or recession, you want to take the opportunity and have the cash to go long, right? Because that's how you're going to make life-changing money. It's by doing that. And I teach that in a course. You never want to be fully invested all the time. You want to go with the cycles of the market. When the markets are good, you want to leverage up. When the markets are bad, you want to get out as quickly as possible, smaller sizing, go more cash and wait for opportunities. You wait for bottom and then you go in for the big opportunities and then you make a lot of money on the way back up, right? Right. So SPX, very similar story as the Qs. We're at a major support level. SFO, we didn't actually break through yet on the SPX. We did break through on the Qs. So this area right here is really, really important. The next level support is around that 4,000 psychological area. And then after that, there's really not a lot of things stopping it from coming down further, right? There's some support around this 3,800 area. And then after that, it is pre-COVID highs, right? So that's a fairly good size drop. So if I measure that, if we're going to go to pre-COVID highs, that's about another 17% drop on SPX. That's a huge drop. You definitely do not want to get into that drop if it does. You want to hedge it. Whatever cash you have, don't jump into the market just yet. Stay there until we see some kind of a bounce and break back above these moving averages, right? It doesn't mean we will drop, just so you know. I'm talking very bearish here, but if next week we have like a big engulfing green candle, which can very likely happen because it happened last time, right? And it happened in 2018, where I thought this is very similar to what happened in 2018. So if I scroll back, this is 2018. So we had this big run up and then we came back. We had like a W bottom, couldn't break the highs right there, and we had that big sharp drop, right? So and then once we have the big sharp drop, it triggered this big giant rally. So if that happens, we could very likely have a very similar situation right here, right? So and also before that drop, right, at the beginning of 2018, we actually saved it came down and we had like a triple bottom, and then we actually did rally back up back to the highs and retest highs before this big drop. So I'm thinking that this could very likely be a similar scenario where we do find some support and then we can rally back up towards the end of the year for the midterm election, and then after that it's going to tank, right? So there could possibly be a last leg up before the big drop. So you want to watch very carefully. It's better to stay cash. I mean, if you want to go short, you get squeezed very hard if it actually does reverse on you. So that's why it's better to cash rather than hedge at the moment. Right. We can go through some different sectors as well. So the growth sector is getting hit hard, right? The growth sector actually broke back below. So SPYG is growth, SPYV is value. So value is still staying above the low of February, while the growth names are already below it, right? So that tells you the weaknesses in growth, which are mostly tech stocks at that time, right? So if we just look at ARKK, you'll see that the tech stocks are actually dropping quite hard. These are high growth tech names versus the blue chip tech, right? Right, and the only thing that was up on Friday was Chinese stocks because they had a change in policy, so they actually gapped up in just a big short squeeze. So there's really no trade until he actually breaks back above the 200-day moving averages on these indexes as well. So don't try to chase these. There could be a little rally and then they'll get sell off if the market doesn't stay as well. So Just looking through some IHI is one of my was one of my favorite ETFs to hold for longer term, and I did get out of it once it broke the 200 right there. So I hedge it, and then it kind of stay in this range, but it was having a really hard time with the 200 right here, and I just decided to just close the position out and lock in my gains. Probably gonna have to pay a lot of taxes on that, but locking my gains, and just not going to go into any sector ETFs at the moment. The only things I am holding is just the SPY and the Qs. So those are my only long-term positions for the indexes. The secular indexes actually took my stops on it once they broke. The ones that I did hedge were fully hedged, and now I'm just taking them off and decide to go cash till they actually go back above the 200-day moving average. Right. Same with bots. Bots was also one of my favorite ETFs, and once that broke down that low right there, I was out. Got stop out, and yeah, I'm waiting for it to come find a bottom, and then I'll go back into this ETF again, because I do believe that robotics and AI is going to be the future, and this could be a really good long-term hold once this downturn is stop, right? So this is one of the ETFs I keep my eye on all the time, right? Same with autonomous driving electric vehicles. This index I actually got out when there was no movement for a while, because it was dead money. I was selling short straddles on it, so I was strangles on it. So I did have some income along the way, but there was no growth. So, and once it went below the 200, it was done. So I got out of that as well. And if this thing comes back down to pre-COVID lows, then I am interested in buying it back again, right? Okay, just to look at some sectors. XLB, which is material sector, it's basing up top as well. It looks like it might be losing momentum soon. So if this actually start breaking down, the commodities actually going to reverse back down, right? So I don't know if that will be the case, since inflation is still staying up pretty high. So when inflation is high, commodities tend to do well, right? XLE, we have the big rally, and then we have the big reversal. So this looks to me was a retest of the 21, and it failed. So next week, if we have some follow through, you want to get out of your energy names and then wait till it finds some kind of bottom and then reverse back up before we re-enter, right? Because it did have a really, really strong run up already. And this area right here was this big resistance area that I drew a while back. So we got into this area, and this is a profit taking area as well. So I thought there was a chance that we could break out of this, because energy prices were staying strong. But for now, it's a little bit extended, and you want to take your profits if it start reversing. Right, XLF already lost steam, so you can see it was consolidating for a while up top, and then it finally broke below the 200, and now all the moving averages come down. So the trend is down. So this is a big part of the value names, and if this is starting to break down, it's going to take growth names and value names go down at the same time, so you'll pick up momentum, and there could be a lot of downside. So you want to be very careful on that. Industrials, same thing, right? These are value names, and they're also starting to look like it wants to break down as well. So, the plays on the value names might be over. So, you just want to keep an eye on it to see where is it going to go. Is it going to break the lows, or is it going to break back above the 200-day moving average? And that will give you a decision on the bias of the move, right? So it's in the range, and you want to see the break of the range, and you can pick the direction. Now, this is high-tech XLK. So XLK, very similar to QQQ, looks like a head and shoulders pattern. Here's the neckline. Once we break down neckline, it's a long way down. So, very, very careful on your tech names. I know you guys love your FANG names, but, in the bear market, FANG names, they tend to drop a lot as well, because they were that's where all the money went into, right? Once all the money went into during the bull market, what happens in the bear market? All that money needs to come back out. So when they come back out, they violently sell off sometimes. So you want to be very careful on how you hold those positions. If they start breaking, you want to hedge it. You're going to hold it for long term, and I think long term they're fine, right? But it's just, do you want to go through the downturn with the stock, or do you want to go through the downturn without the stock? That's the choice you have to make. If you want to hold it, you want to hedge it. If you don't want to hold it, just go cash and buy it back later, right? Consumer staples was one of the best performing sectors, and you can see right now it's showing a top right here as well, and a big reversal. So there's a lot of profit taken now. This is all starting to come together to look very weak on the index overall, right? Because the weak stuff is already weak, and the strong stuff is starting to turn as well. So it could pull the index quite a bit lower, right? So you want to be very careful next week and how you trade. Right now, I am only day trading, and I do hold a few indexes that is fully hedged at the moment, and a lot of cash. I'm just waiting around and try to cash flow while I'm waiting, right? This is the healthcare sector. It was also a good performance sector. Now it's starting to show signs of slowdown as well. As you can see, it's consolidating sideways below 200 again, just like a lot of the other charts look like, right? Yeah, just like I said, watch the range, see what happens within the range. If it just trades in the range, then it's fine. But if it breaks one side or the other, then that's how you know which direction it's going into. All right. Going to look at some individual stocks. So XOM, this is the oil name. I did take my X on the last pop there around right here when it was testing the highs and failed. I got out. So it looks like I got out in time because there was a gap down right here, but it rallied back up and fill that gap and start reversing again around the top. So that's showing signs of weakness. So you want to get out till it makes a new high, right? So Apple, same thing with the index. It went a little bit above the resistance zone, and it came right back down and actually have a gap down right here from the 8 and broke down. That was a big sign to get the hell out, right? As you can see, MACD actually crossed, RSI crossed down, and that was a big sign that you should have got out of that trade or at least hedge it, because yeah, the momentum is going back down. And as you can see, it's still above the lows of February. This is actually March. Huh, okay, so they made a low in March. So anyway, it's still above this low. So as long as you stay above this low, it's still fine. But if momentum picks up, I'm sure that this will come down as well. The big name that sold off last week was Amazon. Amazon did bad on they missed earnings. So Amazon was in this consolidation for a year. It broke down during this little correction here, and it was just in a range in this correction as well. But it rejected this 200 multiple times. That's a really bad sign, right? So you should have been shorting this on the rejection anyways. But around the bottoms where you want to buy back in, right? Because of it was tested multiple times, and then earnings tanked, and that was a huge sell-off. I haven't seen a sell-off like that on Amazon for if ever, right? So this was a huge sell-off on Amazon, and it was a miss on earnings. So most likely, if anything at all, they might try to fill this gap and then go down lower. But it's not good because there's not a lot of support over here. There's this area, this block right here in between, and that's about let's say 200-point gap right here that it could find support in, and potentially hold, and then it's just the pre-COVID highs after that. So Amazon's already taken the lead to start coming down to pre-COVID highs, and that could drag a lot of the FANG names down as well. And Netflix is another big name that dropped as well. So, and these guys have heavy weight on the indexes. So when FANG names start dropping, it's most likely pulling the entire index down with it. So don't be stubborn. When things don't work, get out. Preserve your cash, and find opportunities later, right? Because when the market, when it's bad, you either go short or don't be invested, because some people tell you never to sell. That's wrong advice. That's for people that want to hold stocks for like the next 20 years, right? It's not for people that wants to trade, not for people that are in margin or whatever, right? You should never be in margin during the correction. Once that 50-day moving average breaks, you should never be in margin. If you're in margin, you'll feel the pain of a margin call, which will never, you can never come back from, because once you get margin call, you lost. They give you 300% leverage, so you're going to lose a huge portion of your portfolio at the lows, which is very hard to get back unless you have the money to put in that 3 times the money that you have that they took from you, right? Because at margin call, if you have $100 invested and you got margin called, you probably got $30 left. So be very careful going into margin during these times. Anyway, moving on. Nvidia, another FANG stock, broke down, right? It's continuing to be in this downtrend. It broke out earlier, and then we took profits, and then it started bringing back down. I did try to trade this around the top. It didn't work out. Got stop out. Glad I did, because it went down lower, right? So even, like I said, even great names, they have huge corrections, especially when they have big giant moves on the way up. The faster they go up, they come down even faster. So you want to be very careful when you buy these type of stocks. You want to chase the momentum. You can chase the momentum, but once the momentum's done, you want to get the hell out really, really quickly, or else you end up being this. That's a 50% haircut. So Tesla, so Tesla, they had fairly good earnings, just that they were going to buy Twitter, and Elon had to sell a lot of his shares in order to buy Twitter. So we got this big sell-off right here. But you can see that that time, even during earnings, it got sold off that day. So that was a big sign to get out of the stock. Whenever you see green day turn red, get out. And that's a huge sign to get out, because it means that bears are in control. Right. So it needs to hold around this $800 area. Right. If it doesn't hold that area, we're coming back to 700. If that breaks, you don't want to see that break, because see that break, we're going down to like around 550. That's a long way down. So anybody that's holding Tesla, you want to hedge it. If it breaks the lows of this $800 area, right now it's in kind of no man's land. You can go either direction. So see what happens next week. There's a lot of resistance right here. If it does rally, you'll rally into this area right here, and then you'll find some resistance right around this area at 1,000. Right, 1,000 is a big psychological number. If it breaks, then away we go. But if it gets rejected, you want to get out really quickly. Okay. Microsoft, you can see these are top-in type patterns, right? Big consolidation right around the neckline. This breaks down, like I said, just like everything else is coming down. The level you're looking at, $200, right? So that's a pretty big haircut from where it's trading at right now. So if that comes down to $200, that's about 30% haircut. So be very careful. It doesn't matter if it's a FANG name or not. I mean, I'm sure Microsoft will be there years and years from now, but that doesn't mean it doesn't go down, right? Because they had this huge run in the bear market. Huge runs get wiped out all the way down to the bottom of the range. So, that is a scenario that could happen, and that's a 30% haircut. If you want to hold it, at least hedge it so that you're protected on the way down. But if you don't hedge it and then it drops all the way down, then you have a 30% haircut. In order to make back 30%, you need to make like I think like 60 or 70% to make that back on the way back up. So that's a 60 or 70%. That's a good year, right? So if you're looking for 67% to break even, then do the math, right? Holding stocks through bear markets is not a good thing. If people tell you it is, it's not, right? Unless you're one of those people that just want to buy it, throw it away, don't look at it for the next 20 years, then it's fine, right? You'll come back maybe. And even you do that, I wouldn't pick stocks to do that. I'd probably just pick ETFs where it's safe and like, stress-free. You'll come back because markets do tend to just go up. But during recession, stocks, some of them don't come back, some of them do. And some of them come back even stronger. So you had to do your homework on type of stocks you want to trade with, right? All right, Google broke down. So you can see right here, this was the consolidation range. Once that broke down, it should have been out because momentum is obviously down. And, with Google, there's really not a lot of room. There's some support around this 2000. There's a little gap that needs to be filled slightly below 2000. There's also a gap down here before COVID highs. So you really don't want to see it come down that far. And advertising is taking a big hit, right? Because supply chain issues, a lot of companies are not looking to advertise because they don't actually have the products on hand. So there's really no point to advertise, right? So revenues can drop substantially, even though that they're not 100% in advertising, but that's a huge portion of their revenue. So it does have an effect. Just take a quick look at Bitcoin. So Bitcoin, we're talking about this rounding bottom. It got rejected at the neckline. So once you get rejected in neckline, it broke down on the consolidation, means that's no longer valid. So once that consolidation right here at 45,000, once that broke down, it was done. Right. So right now it's basing again. See if you'll try to do it again. If it does, it's going to make like another little cup and handle. Rather, probably neckline still right here around this 45, 50,000 area. It needs to break through that. Once it breaks through that, then it's going to go. If it doesn't break through that, it's just going to stay around this range for a little while. Hopefully it doesn't break down 35. If you break down 35, then you're looking at around 20 to 25,000. So it's support is about 28, and then it's around that 20,000 after that. So that's a long way down too. And Bitcoin's volatile, right? It's more of a trading instrument. I don't see it as what other people think it's a gold replacement. It's not. And it's supposed to be an inflation hedge. It's not. It's a trade. So treat it like a trade. Don't hold it thinking that it's going to go to the moon forever. Okay. Anyways, that's the update for this week. Hope you guys are all making some money. Hope you guys taking proper precautions in these downturns. And hopefully once this is over, we're all going to make a lot of money again. Talk to you guys next time.